Let's talk about GICs and whether or not you should own some in your portfolio. I'm Rob Tetrault from robtetrault.com. GICs are used as a guaranteed investment tool. They actually stand for Guaranteed Investment Certificate. They're used for conservative investors to generate income, and they provide taxable income for you at a guaranteed level, typically backed by a credit union or a bank. GICs are also guaranteed by the Canadian Depository Insurance Corporation. Check with your institution that is providing you with the GIC to see how much of that insurance is guaranteed. But let's talk about the other things that aren't often talked about in GICs. I often hear someone saying, it's too bad I didn't buy a GIC last year. I could have got 5 or 6%. Well, that's a misconception, because remember, a year or two ago, interest rates were a lot different and you were not able to lock in a GIC at that rate, okay? So GIC rates move in unison with the interest rates, okay? So if the overnight Bank of Canada rate goes up, GIC rates will typically go up. If a credit union or a bank feels like the interest rates are going down, they might pull back those rates. If they feel like the 3 and the 5 year Bank of Canada loan rate are going down, they might give you lower interest rates on a 3 or 5 year. You know, anytime you're in an inverted spread situation where long money gets less interest rate than short money, typically you're going to see a GIC environment at the credit unions and the banks that mimics that. So you're not going to get much more for a 5 year, or you might even get less for a 5 year than you get for a 3 year. That's in an inverted yield situation. So how do GICs work? Okay, you lock them in, typically a 1, a 3, a 5 year. You do not have that liquidity. Now, unless that GIC is cashable, in which case typically pays a lot less, you lose all the liquidity of your GIC. You're completely giving up on the ability to sell that note, sell that investment, sell that GIC, take that cash back and put it into something else. So if you are doing a GIC, if you're investing in a GIC, you're taking a significant and substantial risk, because interest rates go up, you cannot take advantage of that, right? Interest rates go down, perhaps there's a stock market correction, you can't take advantage of that and buy some stocks. Complete loss of liquidity is one thing that you have to factor in. 2, the income is completely taxable. So that means it gets added to your personal tax situation and you will pay tax on that income if it's not in an RSP or a TFSA. So it's the worst kind of income, the worst kind of income. So the best kind of income is return of capital, followed by dividends and capital gains. And of course, the worst one is interest income, and a GIC pays interest income. The other risk with GICs is that you don't know what's going to happen to inflation. In any period where the inflation is high, your GIC's true value gets eroded over time by inflation, because a dollar today is worth a lot less in a year from now with inflation. 5% inflation, it's only worth 95 cents. So that GIC is staying in real term dollars. So you want to make sure that if you're investing in a period of inflationary times, you take a look at other investments that have a natural inflationary hedge built in. Real assets are good for that, farmland's great for that, infrastructure is good for that, private equity, or investment stocks on the stock exchange that can capture inflation. In other words, they could charge more to consumers in an inflationary period. GICs are quite good for investors who are defensive, who have zero concerns about what their returns are, who simply want to make sure that the money is there. I would advise you should consider laddering in a GIC portfolio so that you do have a laddered portfolio. You could take advantage, at least you have some liquidity every year, ideally every 6 months. So you could ladder maybe 10 GICs over the course of 5 years. Every 6 months there's a GIC that's maturing and you could roll that GIC. But remember, no liquidity. You're going to make dramatically less returns than you would in an investment portfolio. You also get taxed on the income, and you risk having that capital eroded to inflation. There you go, bit of a lesson on GICs, guys. Thanks for tuning in today. I'm Rob Tetrault. If you'd like to talk about how GICs could form part of a portfolio, by all means go to www.speaktorob.com to book your no obligation consultation. I'll tell you right now, we do things a lot differently. We can get much better yield than what we get in GICs, and generally we prefer that. Now there will be times when we like GICs and our clients will own a piece of a GIC, but if you'd like to find out more, go to www.speaktorob.com. I'm Rob Tetrault, portfolio manager here at CG Wealth and at Tetrault Wealth Advisory Group. Thanks for tuning in. I'll see you in the next video.